The market really has a lot to react to. On the one hand, the market's reacting to being a little bit surprised at how broad-based and the magnitude of the tariffs, but also surprised at how quickly, Trump rolled them back within a week. So there's a lot of different things to digest. One is, will there be a much broader trade war and much higher tariff barrier?
Welcome to this 23rd edition of Barnes Quarterly. We're here late April. We just ended Easter this past weekend and Holy Week, and it's been a very eventful time since we last did our last podcast. So spring is fully sprung here in Tallahassee, and I think anybody like me that has hay fever has been feeling it over the last couple of weeks with the pollen flying around. But we do have one member in our office who's very happy after the March Madness, and I'll pass it over to Eddie to let him bask in his glory over there as a Gator.
Yeah, hopefully everyone got to see the best basketball team in all the land play over the March Madness tournament.
Well, it was, as always, is a great tournament. And speaking of tournaments, the Masters in my hometown of Augusta did not disappoint this year either. So at any rate, we're in some strange times here as far as the capital markets go, and we're going to be bringing Chris Zaccarelli on here in a minute to help us try and unpack that a little bit. As always, we welcome Chris Zaccarelli up in North Carolina to the show, and Chris, obviously a lot to talk about as we start off the second quarter of the year. It's going by fast, and lots of historic events that have happened just really in the last 2 weeks. But I'm sure the top topic on top of everybody's mind is the Donald Trump's announcement of the tariffs that he was going to levy against our trading partners around the world, and the subsequent impact that that's had just in the 14-day period since that's occurred. You want to talk about that for a minute?
Yeah, I mean, obviously it's been a really eventful year. We're still in the very beginning of the year. We're talking about second quarter, but only 3 weeks into the second quarter. And so, therefore, less than a month into that second quarter. But the story has really been all about tariffs for this year. And coming into 2025, we all knew that Donald Trump had talked a lot about tariffs. He talked about the campaign trail. For those people who've been following him over the years, they know those are something that he's been in favor of. But I think to the extent to which they've applied or announced they're going to apply tariffs around the world to both our allies as well as our adversaries, and the level of which the tariffs came across, I think were a little bit surprising. So I don't think you can be that surprised that there were tariffs in general, or even that the tariffs on China were very high. But I think a lot of our allies and a lot of people in the market were caught off guard by how broad-based and the magnitude of those tariffs. And so you saw that market reaction. Looking at the first quarter, the S&P was down around 4%, maybe a little bit more than that. And the NASDAQ was down maybe double that. But as we sit here only a few weeks into the second quarter, you've got numbers much larger than that. Even with some of the volatility up and down for April, I see the S&P down around 11% as we speak, and the NASDAQ down 16%. So a really big change, or a really big drop off in the last few weeks. And what's changed were those tariff announcements. Now, as you mentioned, it's been a couple of weeks since the tariffs were put on hold, and we really began the month and the quarter with the announcements of across-the-board tariffs. The market really has a lot to react to. On the one hand, the market's reacting to being a little bit surprised at how broad-based and the magnitude of the tariffs, but also surprised at how quickly, Trump rolled them back within a week. So there's a lot of different things to digest. One is, will there be a much broader trade war and much higher tariff barriers than people thought even a couple months ago? And given that everything is subject to change because it can be paused or postponed or eliminated, how do you forecast an unknowable future? And so markets are doing what they do best in terms of taking limited information or incomplete information and making an educated guess on where things may go. And so, unfortunately, where we sit now as we're speaking is somewhere between best case scenario, which is most of the tariffs are rolled back. You see very targeted tariffs on China, maybe at a more reasonable level, and some across the board baseline tariffs. I think the market could live with that. And I think you could see that, when and if we pivot to tax cuts, deregulation, some of the stimulative types of policies that this administration most likely will pursue, you could see a pretty large bounce back in the market. However, the reverse is also true. If it turns out that this 90-day pause ends up being just a pause, and a couple of months from now, when those 90 days are up, we see back to where we started with across the board tariffs across 100 different countries, averaging 20% or more, depending on which country and which market you're talking about. I think the market would have a really hard time with that again. And ultimately, you have to expect that if you're going to tariff something, you'll get less of it. And if world trade drops enough, and that's a difficult number to quantify, but there is some level of damage or headwind to global trade, where if the United States or other countries fall into a recession, you'd see the market fall much further. And so unfortunately, we're in this place where things could get a lot better or things could get significantly worse. And so, given that situation, it's very hard to make decisions. It doesn't necessarily make sense to try to wait this out, because if you do, you'll miss that bounce back if and when it comes. On the other hand, if you think things are going to get much worse, you really need to be in a situation where you've got that diversified portfolio that can ride out the storm and potentially take advantage of the opportunities that will most likely come, as we see within all drawdowns and all recessions.
Very good. So obviously there's been some damage done to the markets, but we've also seen some days, one in particular, where that damage has been significantly reduced because of the surge in the market in a single day. You want to talk about that just for a minute?
Yeah, absolutely. I mean, this is, every single bear market, every single recession is a little bit different. The causes are always slightly different, but you do see certain characteristics that are the same over and over again. And so, a lot of what we saw in the market this year was caused by the announcements of a tariff policy that was more draconian than expected. And as we were talking about, even before the administration reversed course, or at least put those on hold, an administration that can come out with a very surprising and large announcement can also reverse that announcement, or at least put it on hold. And that's what they did. And so you saw the market move down very quickly and drop in a precipitous fashion when the tariffs were announced. And then you saw an amazing rally back. Maybe even half as much was lost over the course of a couple of weeks was made back in a single day, back on April 9th, when the pause was announced. And so again, we're dealing with policy that is unfolding in real time. We're dealing with some of the unknowables in terms of magnitude and breadth of the announcements. And so that's why it's so difficult to try to time the market, if you ever thought you could, by going into cash, waiting for the storm to pass, then getting back in after everything is better. As we've seen time and time again, whether that's 2022, 2020, or even at times during the global financial crisis, some of the best days in the market in terms of moving up happen in the middle of otherwise challenging times. The market typically will move ahead of the news. And so it's difficult, if not impossible, to try to be reading the newspapers and figure out how to switch on a dime, which is why you'll hear over and over again from Stan, myself, Eddie, and anyone who's been in this business for a long time. it makes much more sense to have a diversified portfolio, make sure that your actual portfolio matches your risk tolerance, but that you continue to stay invested throughout these types of downturns because you never know when they're going to reverse. And April 9th is a classic example of that, if not one of the most unusual ones that I've ever seen.
Yeah, we've been beating that drum pretty loudly and regularly to clients, and I think they've heard that message. So, I mean, first quarter was a pretty good quarter. I mean, overall, right? I mean, in terms of corporate earnings and the stability of the economy, we're now, hearing talk of inflation caused by tariffs, which potentially means higher interest rates, instability in fixed income, possibility of a recession. And now you're seeing in the news that that Trump is taking shots at Jerome Powell, the Fed chair. Lots of noise out there. What do you make of this, and what do you recommend?
Yeah, so I think you've really hit on the key points. I mean, the first quarter we had slightly down stock market, at least in the United States. There were markets around the world that were up, but fundamentally speaking, we've seen companies continue to do what they've been doing. They've been continuing to increase earnings. They've been performing pretty well. And again, it's backwards looking. It's looking at the first quarter before any meaningful tariffs were put into place. And as we mentioned, there's been a postponement of some of the announcements. So, right now, fundamentally, companies are operating at a pretty good level. What will change in the future is when and how the tariffs are applied and how uniformly they're applied. In the meantime, we also have the news of President Trump again, talking to Fed Chair Powell, in a public forum. In his first term, if you'll remember, he did a lot of tweeting on Twitter. Here we are in his second term. He's doing it through actually, talking at press conferences and reporters quoting him directly, as well as using other social media ways of getting his message out. I would say that, his calls for Fed Chair Powell to lower interest rates right now are exactly what he was doing in his first term. President Trump isn't the first president to ask their Fed chair to lower rates. He's not even the first person to do it in a public way. But as most things with Donald Trump, he does have his own unique spin on things. He might be a little bit more persistent in his message. He might be a little bit more forceful in how he delivers it. But I would say I don't know that the market is necessarily taking the news that Trump is asking for lower interest rates in necessarily a really negative way. I think the market's somewhat taking that in stride. What does appear to be different this time in Trump's second term is there's been a lot of news stories about how President Trump was looking for ways to get Chairman Powell to be fired before the end of his term. And so as of now, it doesn't appear that he's taken any steps to actually fire the Fed chair. It doesn't appear that he believes he can fire the Fed chair, at least when you listen to the White House, when you listen to the people giving the press conferences at the White House. Although, Donald Trump has said in a few different ways that if he wanted Powell to leave earlier than the end of his term, he would find a way to do it, or he'd be able to do it. And so I do think that makes market participants uneasy. It's not just, people in the United States who are used to financial markets and used to the Federal Reserve having independence, but investors around the world. They've typically looked to the United States and to a lesser extent, England, Japan, and other developed economies, and thought that at least within those economies and within those markets, each central bank was independent of politicians. Obviously, all central banks face some political pressure. All central banks are run by people, and people obviously can be influenced. But generally speaking, as an institution, it's considered to be running, in parallel. And so as long as that continues to be the case, where the United States continues to act like a traditional developed economy where there's independence with your central bank, unlike somewhere like Turkey or other countries where they've crossed that line, fired their Fed chair, and instructed their central bank to do what the executive branch has wanted, that's typically ended badly in terms of much higher inflation, much more selling in financial markets. It's one of those cases where I think you have to be careful what you wish for. If you're President Trump, you absolutely would like lower interest rates. I think pretty much all presidents would like that. But he does need to be careful. If he doesn't want to have issues with the U.S. Treasury market or the U.S. stock market, he's going to have to continue to try to pressure Powell exactly the way he's doing, but not take extraordinary measures and somehow get him dismissed prior to his term, because I think that would probably cause a lot more damage than anything that would be gained by actually having interest rates lowered.
Chris, we've been talking with a lot of the participants that we're currently investing money for, as well as a lot of the retirement plans that we work with, and sort of mentioning what you said earlier and staying the course because you never know what's going to happen. But one of the questions I had was for people that have had money sitting on the sideline or for have new money that's coming in, how are you addressing that? What sort of strategy you're using, and what sort of opportunities do you see out there in the market right now?
So as far as what to do with funds that are available to be invested in the market as we speak, I think the approach is going to be, again, one where, given the uncertainty that we're facing, and given the fact that you already have the market at a slight discount, at least it's less now than it was when we started the year, we think it makes sense to at least invest some of that money. So whether that's 25 or 50% of the money that's available to be invested, take advantage of some of the discounts that you have right now. Invest that money as we speak, and then over time look to put more into the market. What we've done in prior situations, when we were at all-time highs, we might have done a slightly different allocation, and we may have done a slightly different time frame. Something like this, where we don't know what's going to happen within, let's call it, 60 days from now, we think it makes sense to spread that process out. So again, every situation will be different. Eddie, you, or Stan will know specifically what makes sense for any one individual client. But looking at things in a more general level, I would say, generally speaking, putting in that 33 to 50% now, while you do have a market that is significantly lower than where we started the year, and then waiting 2 to 3 months for that next installment, and then waiting another 2 or 3 months later than that. The reason that I would advocate for spreading things out is not only do we know that there's a timeline of that 90-day pause, which as of the time of this recording is a little closer to 60 days, but just giving time for the announcements to come out of the Trump administration. We don't know any more than any of you do exactly what's going to be decided and which direction things will come. As we laid out before, they could just as easily come out with news that the market would love, and we could see a most or a partial, a significant or full market recovery, or conversely, they could come out with news that we've seen before, that they're going to go forward with a much more stringent and strict tariff regime, which we believe the market would dislike. And so that's just another way of saying, the market could easily go up or down from here, and it will be very much dependent on which message the administration decides to take, or which path they decide to take. And we believe, even at this time, they're not exactly sure. You can see that the Trump himself is somewhat torn, listening to the Secretary, the Treasury Secretary Bessent, who's a little bit more market focused and probably a little bit less inclined to have broad-based tariffs, and his longtime advisor, Peter Navarro, who has literally written a number of books about how you want to be as strict as possible on tariffs. And so depending on which advisor he ends up listening to and to which magnitude, that's going to have a pretty significant impact on the market. And so that's why we think it would make sense to spread that out over time and over a longer period of time than normal. As far as things that we've been able to do this year in a concrete fashion, we run a number of different portfolios, at Barnes Capital, whether that's individual stocks, whether that's mutual funds, or in some cases, ETFs and other funds. And within a lot of the mutual fund portfolios, back in early February, we took steps to de-risk some of those portfolios by reducing our exposure to small caps and looking for more balanced or lower volatility funds in the second and third week of March, really kind of mid-March, right in that time frame. We reduced some of our exposure to mid-cap stocks and actually added an international fund. And it wasn't just a typical international fund. It was an international fund that holds a significant portion, 10 to 15% in gold. And so we've continued to try to de-risk from an asset class point of view, but also add portfolio diversifiers. Just like most portfolios will hold bonds to act as some ballast against stocks, we also think it makes sense in a more volatile environment just to have a little bit less of the more volatile equities, such as small and mid caps, and a little bit more in terms of portfolio diversifiers, whether that's a lower volatility approach or whether that's adding in something like gold, which really acts more as a store of value or a diversifier. In the individual equity portfolios, which had a slightly different approach, for the most part, we haven't been holding a lot of small and mid cap exposure, even heading into this environment. And so therefore, it was unnecessary to take those steps. And in some cases, we are holding a slightly higher than usual amount of cash. And so those are different ways for us to try to mitigate the volatility. Again, it's never our goal to not go down when the market doesn't go down, because unfortunately, most strategies that would do that would also keep you from appreciating as much when the market goes higher. But instead, the idea is just try to look for ways to have a slightly less volatile portfolio, a slightly more diversified portfolio heading into greater uncertainty, which we think we're heading into. And then when the time is right, and again, it will really depend on the announcements. If things turn out to be less strict on the trade front, markets trade back higher to all-time highs and keep going, less portfolio adjustments would be necessary. On the other hand, if we continue to see more negative news for the markets, we do believe that in most bear markets, in most significant market events, again, doesn't mean it will happen in the future, but typically it's happened in the past where the proverbial baby gets thrown out with the bathwater. And that's where we'll be looking really closely, especially within the individual equity portfolios, to either add to positions that we think are good long-term holdings, or at the very least, keep our eyes open for very attractive companies at much more attractive prices. One of the challenges of investing when markets are at all-time highs is that very good companies are very expensive. And if you have a good portfolio, which I believe for the most part we've had, you own a lot of those very good companies. But it doesn't really, lend itself to adding even more exposure, because we do believe you want to have diversification in terms of not necessarily being overly concentrated in any one company or stock. But on the other hand, when markets go back down, you do have an opportunity to buy some of those companies that were very expensive at all-time highs, when they're trading at a discount, if the market pulls back 20% or more, which on the equity side is always possible. And so those are the types of things we're thinking about. We're speaking a little bit more in generalities because we won't know what's going to happen until after there are those events. But again, speaking from experience, looking as history as a guide, at least, there have typically been a lot of opportunities, if and when the market goes the opposite direction.
Yeah, well, I heard one of the commentators on CNBC the other day say that there's no such thing as instant analysis on the current situation that we're in. I mean, it's rapidly changing from day to day, and to try and predict any lasting sort of trend is probably an impossible task. But I do kind of feel like there's this good cop, bad cop thing going on between Trump and Bessent. I mean, with Bessent playing the part of sort of the level-headed, logical, market-sensitive, advisor to Trump, and Trump being sort of the, fiery president who's throwing out these tariffs right and left. But I do know that at least if it passes any indicator of Trump's persona, he does care about public opinion. I think he especially cares about leaving a positive legacy after this term is up. And so I do think when somebody said that it is heartening to some degree that he is paying attention to what the markets are doing.
I agree with all of that, and I think especially your comments on President Trump, that does seem to be a lot of his guiding or a lot of his goals and a lot of his motivation. And I think it is good to see, and we did see a couple of weeks ago, just taking the markets into consideration. I think it's all well and good to say, the economy is not the stock market's not the economy. And, he's correct in saying that, not everyone cares about the market, and that is true. But on the other hand, I also think you can't completely ignore the market. We're all subject to the market to some extent. And, the Treasury and the U.S. government, at least from a fixed income point of view, from a Treasury bond and note and bill point of view, are very much subject to the market. So I agree. I think we've seen President Trump, listen to a number of different advisors, see some of the impacts their policies were having in the market, decide to put on hold, at least study the matter further, potentially make some headway with our allies on the negotiating front. And, to the extent that the administration is able to take the feedback, positive and negative, adjust course and plot a better path forward, I'm sure we'll all be better for it. So I hope that continues to be the case.
You mentioned earlier, looking internationally some, and I've seen in some of your handouts that emerging markets have held up pretty well. I was curious, with all the tariffs that have gone on, you would expect prices to go up, demand to go down for those emerging markets. Why have they held up so much better than the domestic market?
Yeah, it's been really interesting because typically what you'll see is in a more volatile environment, you'll see small caps and mid caps and emerging markets all trade down in unison. I think this time has been a little bit of a curveball for emerging markets. One, because this is one of the first market events we've seen in a long time where the dollar is actually weakened instead of strengthened. Typically you'll see a rush to buy treasuries. You'll see a rush into the United States as a safe haven. For this particular instance, you're actually seeing people move out of treasuries to some extent, and you are seeing the dollar weaken. So when the dollar weakens, at least as a U.S. investor, emerging markets look better on a relative basis. So as a U.S. investor, the performance is better than in emerging markets. But much more importantly, a lot of emerging markets feel more stressed when the dollar is appreciating, whether that's because of their funding situation or whether that's because of their export situation. In this case, with the dollar weakening, there's been a little bit less stress than usual on the emerging markets from a fundamental point of view. The other thing that's kind of interesting is that there's much closer linkage between the United States and Europe and Asia, with China being kind of an asterisk because China is technically considered part of the emerging markets, but really is the second largest economy in the world. So a lot of the emerging markets outside of China, and maybe this includes China as well, do lots of trade that has nothing to do with the United States. So in this case, it's also, if the United States is going to create a trade war between its trading partners, if you're an emerging market which is trading with other countries outside of the United States, you're also a little bit less fundamentally impacted. So there's a number of factors that are a little bit different about this particular market event than what we've seen in the past. But I agree with you. We've been kind of conditioned to see a negative U.S. stock market and then emerging markets, as an asset class doing worse, and that hasn't been the case this time.
Yeah, wouldn't you say too? International markets have done pretty well, and that I would think would be attributable to the fact that their markets have not had the run up that our United States market have, and so there are a lot more values relative to our market at this point in time.
Yeah, I think that's true. And some of the things that we just were talking about for emerging markets would also apply to international in general. Again,
weaker dollar.
Yeah, weaker dollar just makes those investments look better on a dollar basis for us. But they've also been in a situation, I think, where you may have actually see foreign money leaving the United States and then going back to their home countries or going to other, what they consider to be more stable, developed markets. And by stable, I mean in terms of policy. It's the United States is still the strongest economy in the world, strongest military in the world. There's nothing unstable about the United States. But if we're going to have a massive change in trade policy and tariffs, those are really big policy changes. So from an investment point of view, it feels unstable because they don't know what the new rules will be. And so a lot of international investors probably were over their skis in Microsoft, Apple, Amazon, that Mag 7. Not only were they chasing higher returns, but because those stocks outperformed all the other stocks, they also probably grew at a faster rate. So just like US investors should keep an eye on how much concentration they have in the Mag 7 or any one particular area, international investors were in the same situation as far as probably being overvalued or over concentrated in certain areas. And then the catalyst was all of this trade war and all of this tariff talk. And so that just got them to make some moves. So you could be seeing money coming out of US stocks and potentially US bonds going into international stocks and international bonds. I think some of that is happening. I wouldn't say that's the only thing that's happening, but that is part of it.
Very good. Well, I think that's about all the time we have for today, but really appreciate you carving out some time for us as always. And we'll wish you a great week ahead.
Thanks. Always great to speak with you. Really good conversation as always, and happy to keep speaking as the events unfold. Hope you have a great week as well.
Yeah, stand by.
Chris Zaccarelli are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.